Hey traders, you ever find yourself in a roller coaster with the financial markets? One moment you're soaring high and another one you're falling low. Well, here's the deal. Knowing when to get off that ride is what can make or break your trades. Don't leave your trades to chance and plan your profit. Learn to lock in your gains and cap your losses, saying goodbye to emotional trading decisions. Today, we are taking a look at exit strategies. And just before we continue with this video, I noticed that most of you are not subscribed yet, so if you're enjoying our content, don't forget to click that subscribe button. Okay, let's start with the two most basic concepts when it comes to exiting your trades: take profits and stop losses. Stop loss orders are used to specify the exact price at which a losing position is going to be closed. A stop is an instruction for your broker to either buy or sell the asset at an exact price that you've specified beforehand. When the stop loss is triggered, it instantly turns into a market order, helping you to prevent a big loss if the market moves against you suddenly. Note that a stop loss does not guarantee you the exact price that your trade is going to be closed. That is most important in extremely volatile conditions like market crashes. You're going to be closed at the next available price. Another order that you need to be familiar with when building your exit strategy is the trailing stop. A trailing stop is placed at a specified distance from the price, and it basically is what it sounds like. It is a stop that trails the price as the price goes up or down, whichever direction you're trading. This type of order is used to lock in profits when the trade is moving in your direction, making sure that the stop loss comes up with it. For example, you open a position and add a 10-pip trailing stop. As the price consolidates, the trailing stop moves up every time the price goes in your direction. That is until the price stalls and starts reversing. That is when your trailing stop loss is going to stay at its most recent price. So, trailing stops associated with long positions can only move up, and those associated with short positions can only move down. A take profit, on the other hand, is an order that is telling your broker when to close your position, but not when in loss, but instead when in profit. Like a stop loss, it converts the order into a market order when the price is reached and it closes the position. There should always be a rationale to where your stop loss and take profits are placed. We're gonna get into some of the exiting strategies that our traders use in just a little bit, but we need to go over a few more concepts before that. When placing our stops or take profits, we need to consider the asset's volatility. The price should have enough room for fluctuations depending on the time frame that you're trading. If you place your stop loss too tight or too close to the price, it could be closed prematurely. There are multiple methods that take volatility into account: technical or fundamental factors, support and resistance, the Fibonacci levels, indicators, patterns, and more. We're gonna get to it. The important thing is that they're put into practice aligned with the time frame that you're going to be trading on. So you have to think about whether you're a day trader, swing trader, you're a scalper. It's all going to depend on where you're going to be placing your stops and your take profits. And also gonna affect your exit strategy. When it comes to exit strategies, another important concept to keep in mind is your risk to reward ratio. This shows how much you're ready to lose in comparison with how much you're hoping to make on that trade. For example, you go long, you place a 20-pip stop loss because you don't think that the price is gonna move in that direction more than 20 pips, and based on your analysis and your predictions, you're expecting the price to move about 40 pips long. So you choose that point to be your take profit. Now that we have these two very simple orders, we can calculate what our risk to reward ratio is. If you're not familiar with it, it is simply the amount of risk compared to the amount that you're hoping to make. So in this case, it would be 20 to 40, or our risk to reward ratio would be 1 to 2. The final risk to reward ratio that you should be using for your strategy is going to depend on multiple factors that affect the strategy. But in general, you shouldn't be accepting anything less than 1 to 1 to keep your strategy profitable. With our personal recommendations, we would even recommend going to at least 1.5 or 1 to 2. Risk tolerance affects your ability to handle a loss. If you take on too much risk, there is chance that you're gonna panic and close the position too early. A trader has to pick a comfortable percentage of the remaining risk capital that they're willing to lose on every trade. The more risk tolerant the trader is, the more loss they're ready to withstand. If you're trading your own money, you can be fine with losing 1% of your account on every trade. But if you're, for example, trading for a prop firm, or you're trading a funded account, you're trading for investors, you have to keep in mind that you may be bound by a drawdown limit. In that case, what I recommend is that you look at the remaining risk risk capital, or the difference between your balance and your drawdown limit, as your entire remaining risk capital, and that's what you base your percentages off of. The concept is still the same, but when you're trading for someone else, you need to look at the money that you can lose as everything you have. Alright, so there are numerous exit strategies, most of them based on technical indicators. Now we will take a look at a few popular strategies that our traders use to place their stop losses and take profits. The average true range indicator can be used as a signal to exit your trade. ATR is a common indicator that helps estimate the asset's average volatility, taking into account a certain time frame, like minute, hour, day, or week, for an indicated period. To calculate the stop loss level based on ATR, traders will usually use some sort of multiplier. These are often anywhere from 0.5, 1, 2, 3, or 4. That is going to depend on your strategy and even more on the time frame that you are trading. Generally, long-term traders or swing traders tend to multiply by higher numbers, while short-term traders multiply by a much smaller number. The value you will receive from this multiplying is your stop loss level. The logic behind this strategy is to subtract multiplied ATR from the recent close, and then you put your stop loss at the distance that you've calculated. In trading, support and resistance are used to describe certain levels where price tends to change direction. Think of support like a floor where if the price drops, it tends to bounce back up. It's like an imaginary line where buyers come thinking that at this price, this given asset is a good buy, and therefore they push the price back up. With resistance, you can imagine this as a ceiling or a barrier that the price is trying to go up through but struggles. At this point, the sellers outweigh the buyers as they think that this asset is overpriced, that it's too expensive, therefore they're pushing the price back down. And trends can sometimes reverse at these levels. That's why traders use them as areas to put their stop losses and take profits. The general recommendation is to put your stop loss slightly below a support or slightly above a resistance, just to make sure that you don't get closed out directly at those prices. So, support and resistance are another places that can be used as an exit strategy by placing stop loss or take profit orders there. They are prominent price areas that can serve as a place to exit. This exit strategy suggests that you should get out of the trade once the entry criteria disappears. Let's imagine that a stock X makes a series of higher swing highs and higher swing lows. This indicates an uptrend, so you decide to buy that stock. In a while, the price of the stock starts to have lower highs and lower lows, indicating that the trend is no longer an uptrend and that your entry criteria is no longer valid. The reason you have entered this trade is gone, and according to this strategy, it's time to exit the trade. Here's another example. You may have gone into the market because of a bullish indicator. When this indicator no longer suggests a bullish market, that would be the moment to exit your trade. The drawback of this strategy is its sort of subjective nature. The reversal of a trend or the change of an indicator don't necessarily have to mean that it's the best time to leave. Such things only tell us that the reason to enter has vanished. And alright traders, that's a wrap. Today we have had a quick look into the world of exit strategies. If you found value in this video, don't forget to hit that subscribe button below. And remember, a planned exit isn't just a safe exit, it's a profitable one. Thank you for watching today's video. Mine has been Oliver from Lux Trading, and have a great one.